We've got a little dip with the S&P 500. This big red candle from last week, it's roughly about 3%. Now, with my video from about 2 weeks ago, I was talking about a potential NASDAQ 100 tech bubble incoming, and this was, for the S&P 500 as well. Just a bubble across the US, and why that is not really a good thing is because when we get a big move, the market, it can crash and it gets really, really volatile. And when the market gets really volatile, then myself and many other investors are likely to make some pretty silly decisions during those times. So it's actually not what we want. Now, we have to be prepared for a bubble because if it does come, it's also an opportunity to make a lot of money really, really quickly. And the point of the video was, all right, just be ready for a bubble. Make your strategy now, make your plan now, so then when it does come, you've got a higher chance of success to actually sticking to that plan. Because if you're trying to make a plan in the moment, when your emotions are all heightened and all of that, we can't actually think very clearly. So as investors, the saying is you got to be thinking like a rock, have your emotions solid like a rock. If you go to, become too happy, you're probably going to get greedy. If you become too fearful, it's the opposite of that. So you want to stay dead center in the middle, because whenever you sway from that, your IQ actually drops. So, I've got the famous S&P 500 chart, the road to financial freedom. And, over the last, couple decades here, it's been constantly trending up higher and higher and higher. And, the green line is saying it's really cheap. The white dotted line is saying it's fair value and it's a decent buy. And then whenever we get close to the red or above the red, that's when it is expensive. So what I would actually want right now is, we've had this dip at a 3% and people are starting to get a little bit scared. But honestly, what you want is you want it to just hover around the white line. Because the longer we stay around the white line, we don't really have to be scared about anything. Like if it just runs up, then we have to be scared of these massive, massive corrections, which is what we had back at the start of 2022, end of 2021. We had that big correction, 40%. So, and I made a couple mistakes in here, which I'm not really proud of. Which if I hadn't made those mistakes, I'll be making a lot more money today. So in the ideal world, if I could choose, I would just like to make this. And if the market can go up at this pace, it's probably 10 to 12% returns forever. And that's what I actually want. So right now, in an ideal world, I would actually like it to come down and correct a little bit more. And then, because if we're buying in at these prices and we're a long-term investor, it actually sets us up for more financial success in the future. So it's kind of like, if you're really praying for this thing to run up as fast as possible now, it's like, well, eventually the stock price is going to get there. The price is eventually going to get there no matter what, because just about how the S&P 500 itself as an investment is structured. It's the top 500 assets in the world. It's based on a mathematical formula. If a company falls out of that top 500, by market cap, the valuation of these companies gets automatically delegated out of that bucket and replaced with something better, right? So it's mathematically recycling and keeping in all of the good stuff. So eventually, if the price is eventually going to get here, why are we in a rush to get there? Like, would we rather it go up like this and then boom all the way down and like that? I'm like, why? Why do we need that? I'd much rather just get something like this, very, very smooth every year, 12%, 12%, 12%, 12%. I would much, much prefer that. So imagine if we could, imagine the S&P 500 makes around 10 to 12%, right? A lot better than a bank account. But if a bank account made those same returns, so it just paid you out interest every single year, 12%, 12%, 12%, with no volatility, the bank account would actually be better, right? Because it's not going to play with your emotions. It's guaranteed 12% every single year. Because that's the downside of the S&P 500. Yeah, you make a lot more money than having a bank account, but it messes with your psychology going up and down with the volatility every single day. So yeah, I personally wouldn't mind it coming back down to the white line now. I would actually prefer it. I've already made enough money this year, So if I go to check out the eToro stats, we're already up 29% this year, and it's July. It's like, how much more do we want? Back in the past when the market was really, really pumping, 2020, 75%, 2021, 46. These are big, big numbers. And then what happens after you get these big, big numbers, right? You get big, big correction, negative 38%, right? Then 2023, 24%, that's actually my average I'm at. So if I look at the stats here, here's like a fact sheet from last month. Total return annualized. So my average results when you calculate all of this, right? 75% starting in 2020 until today is 24%. So another way to be thinking about that is I think I will roughly stay around that, maybe even a little bit lower, between 20 to 24%, even just say 20%, as we move into the future, I'll stay around an average of 20%. So what we should actually be thinking is, hey, if Dylan is beating 20% this year, odds are the next 12 months, they might not be as good. So like with investing, you're always reverting back to the mean. So if I'm averaging out 24% every single year, and then imagining 2022, I'm down 38%, it means the next few years are probably really, really, really good, right? So it actually works in the opposite effect. But what investors do is whenever someone loses money, then they exit out of the portfolio. They think and they forecast that this is a new trend and it will continue forever. It's actually not. It's going to revert back to the mean. We have to look at the actual portfolio and what are the actual assets that we're holding. These are top quality assets that will come back, right? And that's the beauty of the S&P 500. They are the best assets in the whole world. If the market is down 40% like it was during 2022 to 2023, the market's going to come back. So you should expect, if the market went down 40% like this, you should then expect better than average returns the next few years. So you should actually get more bullish. You should get more happy when the price is coming down. So that's a big one, 40% from here. So that's what I'm saying with this. If we just get a little fella down to the white dotted line here, we should actually get happy because the next couple years from then forward will be outstanding, So if this little dip here is only 3%, if we came down, just say maybe to the previous high, you can see my alarm here in the green line. I've got a horizontal alarm here. That's a 7% drop. I will be getting pretty damn bullish at that level because what the market likes to do is you go up, you make a high, you go down, you make another high, and you come back and you revisit that level. That's how the market likes to move. So if the market does dip a little bit further down to 7%, I'll be thinking, great, closer to the white line, great buying opportunity. I'm definitely not going to be afraid, and I'm going to continue with my dollar cost averaging here. Because it's actually a better valuation. It's a better price to come in at. And if the market comes down 7% and then we give up a little bit of these results, 29, imagine we go down to 22. Perfect. We're back near the average of the total return annualized. And, so then we can think we're at the average. The next year is we probably continue the average roughly. But imagine if we end this year with 50% and the market's all the way up here, right? You can't possibly be thinking, hey, this Dylan Weston dude is going to be up 50% the next year. Like, if we're up 50% the next year, what's the market going to look like then? That's the bubble, So we have to be thinking in terms of what is this investor's or this investment, what is the averaged annualized returns, and what do we expect them to be into the future? Right? If 1 year is massive, 50%, it's highly unlikely that there's going to be back-to-back 50% every single year. If it goes above the average annualized returns, we should actually expect that the next following year or the years after will probably be worse to get back to that average. And that's what an average is, right? It's the average of everything. So, unless there's been something real crazy that's been developed with the strategy, where you've really learnt something so you can actually single-handedly, confidently change the annualized return moving forward, or you think you can moving forward, That could be a thing. But with myself, my strategy has not changed at all. So I believe the annualized returns will not really change. So if you're dollar cost averaging into my portfolio, I believe, around 20% returns is it's quite realistic. Obviously not guaranteed, but quite realistic. If you dollar cost into the S&P 500, I'm expecting 10 to 12% returns over the next decade. A lot of people have said, like it's actually less than that. And maybe it is if you count the whole entire history of the S&P 500. But I think the S&P 500 is actually becoming a lot more sophisticated because there's different people running today's businesses. The people that are running today's companies in the S&P 500 are a lot smarter because they have the ability, or they're fortunate enough to be able to research the companies which came before them and learn from their mistakes, right? So it just makes sense that over time these companies become more and more profitable. If you think about the biggest companies, originally they're like the steel manufacturing companies and all of these things where there's not really big profit margins, right? They're really capital intensive. Where if you look at today's businesses, a lot of software, technology, all of that stuff, they're night and day difference with the businesses from the past. So that's why I believe, the S&P 500 can actually start potentially compounding above 10% returns, annualized, on average. So that's my thoughts with that. That's kind of a little bit of insight about how you should be thinking about me if you're investing in me, or if you see the S&P 500 is up 20% one year, then up another 20% the next year. You shouldn't be getting excited that the S&P 500 is going to keep continuing at this 20% compound rate. It's just not realistic. You should then actually be expecting a correction, which is what happened after COVID. Great returns from COVID. Measure this, right? If you invested at COVID near the lows, this is March 2020, boom, all the way up to, right, January 2022, right? It's less than 2 years, 120% on the S&P 500. All right, people are saying, oh, the S&P averages 10% per year, which it does. Look at these 2 years, right? 10% plus 10% is, roughly 20%, right? 120%. That's a lot bigger than 20%. Now, because we got that massive run, it's not realistic that it can sustain at that rate. So what do we get? We get a massive correction down here, 28% or so with the S&P, more with the NASDAQ. Now, if it was going to continue the S&P at that rate, where's it going? Let's just draw it out. Oops, it's a bit of a curve. If we draw it out like that, come on, zooming out, that doesn't make any sense, right? Sometimes we just need to think, with common sense, right? This does not make any sense. The S&P 500 at today, like if it was going to continue that trend, it would be above 10,000 today, right? We're only at half of that, 5,000. Yeah. Anyway, that's been a bit of insight. If you've got any questions, you know what to do. Thanks for watching this video. I'll see you in the next one.